Welcome to Module 4 of the 7-Step Guide to Trading presented by Tackle Trading. This is Coach Matt. It's a pleasure to be with you here yet again, and let's get right into it. Now, before we get into Step 4, let's specifically talk and review about Step 1, 2, and 3 very quickly. Step 1, we want to start at the top of the markets. The reason is very simple. We want to create a bias to the market. Are we bullish? Are we bearish? Are we neutral? Once we've determined that bias, we want to trade in the direction of the overall trend. And so Step 2, we want to choose the trading strategy that best fits what the market condition is. Step 3, we want to find and analyze potential trades. And in Module 3, we talked a lot about, using those scouting reports, but there are a lot of ways to find potential trades. Those scouting reports are some of the best, and we'll talk more about those scouting reports here later on into Step 4. And that's what we're going to get into right now is Step 4 in terms of planning the trade. Once we've found our bias and we've chosen the strategy and we've found the stock we want to employ that strategy on, now we just got to plan the trade. And in planning the trade, you want to think about 4 things: entry, stop, target, and position size. Now, what the P stands for in plan the trade is what is the price criteria for your entry. So in terms of buying a stock, what price are you willing to pay for that? In terms of shorting a stock, what price are you willing to sell that at? And that's based on your technical rules for trading, day trading, swing trading, position trading, whatever your own personal technical rules are. That is what the P stands for. Now, the L stands for what is your likely profit target? Higher highs, higher lows, old area of support and resistance, Fibonacci levels, moving averages, significant whole numbers. What's that profit area that you are targeting so that you know where you want to lock in? Now, in the A stands for always have an exit strategy, and that is specifically regarding your stop loss. And I'm going to go over a stop loss rule here later on in Module 4, a rule that I've been using for years and years and years, and one that I really like, and I'll get into that later on in Module 4. And then the N simply refers to as never over position size. We want to make sure that we're position sizing according to risk regarding options, and we want to never over leverage in any one trade. We like to put on lots of trades with lower position sizing as a trader. Now, in terms of planning the trade, you always want to trade with the overall direction of the trend, as we talked about in Module 1 and a little bit in Module number 2 as well. So your first type of trend that you have is what we call a bullish uptrend. It's a very consistent pattern that deals in higher highs, higher lows, higher highs, higher lows. We're looking to trade breakouts of previous levels of resistance here, or we're looking at trading the support bounces, what we refer to as a bullish retracement. So in terms of the breakouts, once it breaks out right here, that's a good little trade setup, and then it gets overextended, retraces back down into your support channel. That's what we call a bullish retracement. That's a good technical setup as well. So we're looking to buy at support and sell at resistance. So BTO stands for buy to open. The STC, sell to close. Buy to open, sell to close. Buy to open, sell to close. Repeat after me. Buy to open, sell to close. Repeat, 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 because that's what patterns do. That's what history does. It, in fact, doesn't repeat itself. Now, in a bearish downtrend, we obviously want to buy put options or short stock to make money and be profitable as markets do, in fact, go down. And what the STO, we want to sell to open to start the transaction. And then when it gets overextended into our support level, that's where we buy to close the trade. So instead of buying first when you're shorting stock, you are selling first. So sell to open the transaction, you buy it to close. Sell to open, buy to close. Sell to open, buy to close. Sell to open, buy to close. And if you're very new to trading, just chant that over and over and over again, and you'll be surprised how quickly you do catch on. Now, let's go ahead and let's just start talking about what it is about planning a simple trend trade. And this is what we call a bullish swing trade. Now, in a bullish swing trade, we want to buy at support and we want to sell at resistance. So as you can see in this example, we have a short-term bullish uptrend. It's breaking out of an overall neutral trend, which is a very positive sign. We've made the decision that we want to buy it because it broke out, retraced back down, forming the bullish retracement. Now, the first thing we have to get is what we call the price that we're going to pay to get into the trade. Now, I don't want to buy as the stock is going down here. That's not what we want to do. We want to buy as the stock is coming down into your support level, and then as it starts going back up. So instead of buying as it goes down, we buy as it gets into support, and then it starts going back up, and that is a concept we call confirmation. The L stands for your likely price target, the A stands for your exit strategy, which is your stop loss, and the N stands for never, ever, ever, repeat after me, over position size. More trades, less allocation. And when we're talking about leverage in options or stock, it doesn't matter. If you're not willing to lose $400 in a trade, don't buy 200 shares in this example. Lower your shares. You see, everybody can still make the trade. They're just going to do it with less shares. In terms of the orders that we're going to place on a trade like this, your entry order is what we call a buy stop order. That buy stop order indicates that we're willing to pay the price we're willing to pay or above that price. Now, if you want to control that, you want to do what's called a buy stop limit order. But for right now, a buy stop is anything at or above the price you're willing to pay. Now, your sell limit order is you are willing to accept X amount of dollars or I'm not getting out of the trade. And then your last one is what we call your stop loss order, and that is an order that's called a sell stop order. Now, if the buy stop is at or above the price that you've indicated, a sell stop is at or below. So if we're buying this because it hit 90 and starts going back up, anything under 90, I want to get out because that means I'm wrong on the trade. I bought it because it was hitting support. I bought it because I thought it was going to go up. It's now no longer going up. I don't want to be stuck in the trade. I just want to get out and go find a trade that's going to work for me. I don't want to stare at the chart in any capacity. If the stock does appreciate to your target, it's going to automatically close the trade. On the flip side, if it goes down to your stop loss, it's going to automatically close the trade. Now that we kind of understand the concept a little bit, what I want to do now is I want to go live into the market to show an example of a scan report from this week, how we would go about prepping that trade. Now, once again, you're looking at one of my analytics software called the Dynamic Trend Profile. It's a software I like to use to teach from and charting and some scanning. But for the most part, I do work within my broker software. Now, you're looking at egg resources here. Now, in terms of that, how did we find this? Well, let's go to Tackle Trading. Let's go to the reports. Let's go down to the option report. And in Module 3, we took an example from December 1st so that we could show a trade that came through fruition. But in terms of the options report, let's go ahead and look at the options report from this week, and let's find a stock that we like the technicals behind it. Now, as you can see on the bullish side, I got 1, 2, 3, I got 8 different trades that are all potential trades. On the bear side, scrolling down here, I got 1, 2, 3, 4, 5. I got 12 trades that are potential bear trades. Now, I'm not going to trade 12 bearish swing trades next week, and I'm certainly not going to trade 8 bullish swing trades next week. I want to pick the ones that I really, really like. I use these as a watch list. I pick the ones I like. I feel like I have people that I trust scanning for me, and I just get to pick the ones I like. So I'm going to kind of go down the list very quickly. Apple, Best Buy looking really good. Dish looking really good. But here we come to egg, and I just love this retracement here. I love the momentum to the downside. I love it retracing back up into the breakout channel. I love that it's already confirmed coming on the way back down. Easy trigger right underneath the low of the day of the candle. So that's why I picked egg, was I just love the technical setup behind EOG. It doesn't mean it's better than, say, Best Buy or LYB or Urban Outfitters or Tiffany's or anything like that. It's just that's the one that I personally really liked. All of them are great swing trades, but again, I use this as just picking the ones that I personally want to trade that week. EOG. Now let's go back into the analytics software and let's look at how this trade would work out. Now, in Module 3, we showed you a back-tested case study about how this works. Now, we don't like shorting in between the candle. Once we have our confirmation candle, we like getting in with the tackle traders. We like getting in underneath the low of the day. Now, if we go back to the options report here, the options report says, okay, the entry price on EOG is under 95.96. The stop loss has to be above 100, and the target is based around 83 to 70. Let me walk you through with how the coaches got those entry stops and targets. The entry is the first thing, and the entry is really, really simple. Upon confirmation, we want to get into the trade as it in fact goes underneath the low of the day. So the low of the day is 95.96, and that's because the stock is already confirmed moving down. If the stock had not confirmed, there would be a different rule there, but since the stock has already confirmed going down, we're just going to get in as it continues to go down underneath the low of the day. And so that's right under that 95.96. Now, it's up to the trader to determine exactly where that goes underneath that level. That is a minimum standard. So we're going to put our entry, and let's get a line to signify our entry here. So we're just going to put our entry right there. And the stop loss said we had to be above 100. So as you can see, this resistance pivot right there, that happened right at 99.50. $100 is an old support level over here, new resistance. So we're going to put that stop loss right there at 101. Our risk is from our entry, and we'll just put our entry 95.50 right underneath that 95.96. Stop loss is being placed at 101. That means I have a risk factor of $5.50. Our targets were 83 by 70. The first target on a retracement is here at your previous level of support. So when you're dealing with a bearish retracement or a bullish retracement, first target is, I shouldn't say always, it is typically the previous level of support or the previous level of resistance, which in this case is right there at $83. So that's my first target. My secondary target is based on a concept that you will learn in time at Tackle, and that is called potential average yield. And when you're looking at potential average yield, you're looking at understanding the life cycle of the trend. This is called a motive wave, corrective wave. Motive wave, corrective wave. We are projecting the next motive wave down here. In layman's terms, I'm projecting that it's going to go down. It's lower low, lower high, lower low, lower high. But if you look at the consistency of the lower low, lower high, in these downward movements in price, this moves right at about 32.5 points. This secondary movement here, it's moving at 27.5 points. So if you have your first movement move at 32.5 and your second move at 27.5, we're going to target the mid price, and the mid price is right in 30. Well, if our old resistance is now at 100, 100 minus the average yield of 30 would have a secondary target right there in the $70 range. Our risk is from our entry to our stop loss. That defines our risk. Our return is from our entry to our targets. Do we have a good trade? I don't know. Let's run the numbers for a second. So let's go into the broker software. Let's go to the Analyze tab. Let's hit the Add Simulated Trade. I'm going to go buy a put option here because that's what I do as a trader. I'm going to go buy a put option. It's going to cost me $8.25. $8.25. Now, in terms of that $8.25, that is per share. Per share, there's 100 shares in a contract. I'm paying $825 per contract. If we go to the risk profile, this is what a risk profile looks when you're looking at shorting a stock, and this specifically is one on buying a put option. As you can see, as the stock goes down, we make money. As the stock goes up, we lose money because we are projecting that the stock is going to go down, and we are buying a put option that makes money in that environment. We're putting a stop loss at 101. We are going to target, and we're entering at 95.50. And we're going to target 83, and then ultimately, and we're going to add a slice there, ultimately 70. As you can see here, our entry of 95.50 equals $70 profit. That's not accurate. That's based on us getting into this trade right now with where the current price is. So our real loss would be right around $277. So our risk is $277. Potential return at our first target is $900, and at our second target, if we're accurate, is $2,100 since we don't get the additional $70. Is that a good trade? Is that a trade that has a high probability of success? The answer is up to you. If that's not a high probability setup, then go find another trade. Very simple. There were 20 different picks. Go pick a different one. I personally like that trade. I like the reward to risk ratio. I like the probability of that as well. So coming back to what we've been talking about in the past, remember in Module 3, and I went through those 4 different techniques. If you need a review, please do. Well, in this situation, I would say we have a higher than 50% probability. Our return is $2,100 and $900 versus a $277 risk. We have a substantially higher return than the risk. We're looking at a technical environment where the stock is getting absolutely butchered over the last 3 months, and all I'm saying is the stock's going to continue to do what it has been doing, and if it continues to do what it has been doing, and I'm just going to simply put myself in a position to make money, in this example 900 or 2100s, depending on what target it ends up ultimately going to, and I simply want to put myself in a position to make money in that environment. High return, low risk, good probability. After we make the trade, and we'll get into this in Module 7 in depth, but I just want to quickly talk about it. We got to journal the trade. We got to document all of your trading. We got to make sure that you stick to those plans. And the only way to do that is by keeping a trading journal. Paul says this about tackle trading. Very active environment for traders. This is a very active environment for trading enthusiasts and professionals. They offer a plethora of resources and live shows, and the support is also top-notch. If you have been enjoying what you have seen in the 7-step guide to trading presented by Tackle, then sign up for a pro plan. Sign up for a pro plan and we'll give you 15 free days on us. It's a $97 subscription after that. 15 free days on us, and what do you get? Well, you get all of our rookie and varsity content. You get access to all of our blogs. You get access to all of our scanner reports, the stock report, the option report, the commodity report, and the forex report. The options report, that's where we got that EOG trade. That's where we got that Goldman Sachs trade from Module 3. You get access to the Traders Lounge. If you have a question on a trade, if you need help with your software, if you just want to sit in a trading environment and listen to a bunch of traders talk about trading all day long, well, get into the Traders Lounge. We do it every single day over there at Tackle Trading. Get into our coaches shows. Our coaches show on Tuesday night where we analyze directional trades, swing trades, delta trades, the stock report, the options report. Get into our cash flow club where we're talking about calls and naked puts and credit spreads every single week. Get into the mind of the trader. Start working on the proper trader mindset. And if you are new to the market, we have some great educational series that we call the Tackle 100 series that as a pro member you get access to. Technical Analysis 101, Options 101, Futures 101, System Development 101. And you get access to all of that as a pro member of Tackle Trading. So definitely sign up by going to bit.ly/join-tackle-pro. Once again, that's bit.ly/join-tackle-pro. In our next module, we're going to talk about placing the trade. We prepped the trade, we found the trade, we prepped the trade. Now let's go out there and place those trades. This has been Coach Matt for Tackle Trading. Hope you enjoyed Module 4. Looking forward to Module 5.